Welcome everybody. I'm Michelle Allen from the Chartered Banker Institute, and I want to thank you all for joining us for today's webcast. Brexit is one of the hottest topics right now, and Raoul Ruparel from think tank Open Europe, who have a neutral stance on the pros and cons for Europe, is one of the most in-demand speakers on the subject. So I'm delighted that he agreed to present Brexit, the issues and impacts for financial services for us today. You do have an online facility to enter any questions that you have for Raoul, and he will address as many as he can at the end of his presentation. So thank you, Raoul, and over to you.
Well, thank you, Michelle, and thank you for everyone tuning in. As Michelle said, we have a neutral stance, so today I'm just going to try and explain some of the potential impacts of Brexit on the UK economy and on financial services in particular. But I'll start by giving a quick overview of the state of play in the referendum and how I see things developing and therefore what the chances of Brexit are really at this current point in time. So I think if anyone who's been following the debate can see is that the polls are very close, and as we see in this first slide, they're neck and neck at the moment essentially. But the real question is, how much can we trust these polls? We know that in the general election last year, the pollsters got it very wrong, that actually many people are questioning whether they will be any more accurate this time around. And I think one of the problems we're seeing is that polls done over the phone and polls done online give quite a different reading. And you may notice this when you're following polls in the newspaper. Some come out with quite a large lead for Remain. They tend to be the ones done on the phone, whereas others have them much more neck and neck with a higher number of don't know or undecided voters. And those tend to be the ones done online. So there are some explanations, although I've spoken to a lot of pollsters and none of them have particularly good explanations for why this is. But I think one of the reasons is that on the phone you don't always get given a don't know option, so people tend to be forced into giving an answer, and they tend to come down for Remain, which itself might be telling. But there's also some evidence that the phone polls reach a more liberal audience, a wider audience, whereas the online ones tend to reach a more conservative audience and have some sort of self-selecting bias in terms of the people that take part. So those tend to account for some of the differences, but even then it's not obvious which one better represents the views of the population. For what it's worth, my sense is that the phone polls tend to better capture the full view of the general population. And if this referendum was about the full view of the general population, I think we would probably end up voting to Remain. But it's more about who turns out on the day. And I think what the online polls do tend to show is what more politically engaged people think. So there is a risk that there is some confusion between which of the polls better represents the views of the population and the outcome of the referendum. So there's a lot of uncertainty there, and I can see why people are sceptical of the polls, and my sense is it's still too close to call at the moment. There is some use in looking at some other polls that are a bit further, into deeper issues, looking at what people think is an economic risk, staying or leaving, what they think it will mean for their future, for their family. These kinds of issues tend to show a bit of a bigger lead for Remain, and they also proved a bit more effective in the general election in predicting the outcome. So there is some underlying polling there which suggests maybe Remain has a slight lead, but given the closeness of all of this and the uncertainty of the polls, it could really go either way at this point in time. I think there are other indicators to look at as well. For those of you who are interested in following the money, the betting markets are actually showing a much larger lead for Remain and showing an implied probability of a 70% chance or so of Remain winning. So clearly the betting markets are much more confident about the outcome. I would say probably a bit overconfident, but clearly people are, in terms of where they're putting their money, expecting Remain to win. I think a lot of that is because there tends to be a status quo bias in referendums, and maybe a lot of people, particularly in financial services, are hoping maybe rather than believing that Remain will win. So, there's a bit of a difference there between the betting market and the polls, but generally my view is that it's too close to call, and therefore it's very important that we examine the potential impacts of Brexit. So the first thing I wanted to mention, when you're considering the impacts of Brexit, the short run and the long run are important to distinguish between, and they can be very different. So what I would say about the short run is it's incredibly uncertain. All of this is very uncertain, of course, but the short run in particular. And the day after a potential leave vote, nothing actually changes. The process for leaving the EU is through something known as Article 50, where the UK government notifies the European Council that it will be leaving the EU. That then triggers a 2-year process of negotiation, where the UK would negotiate its transitional arrangements, which would deal with issues ranging from the status of migrants in the UK and in other countries, and it also negotiates then what it moves to in terms of another free trade agreement potentially with the EU, which I'll talk a bit more about in a moment. And then it's also a question of what the UK does with domestic policy. So there's lots of moving parts there, and clearly doing all of this in 2 years is going to be a huge challenge. And frankly, I think it will be something that is unlikely to happen. Most evidence I've seen suggests that negotiating free trade deals with the EU takes anywhere between 4 and 10 years. The figures for other countries negotiating free trade deals aren't that different. So this period of 2 years can be extended, but it would require unanimous support amongst the rest of the EU. So that itself is a big piece of uncertainty. We know there will be this transitional period, but we don't know how long it's going to last. And so until we get a clearer picture of where the UK is going in its Brexit negotiations, notably we don't have a plan at the moment. The Leave side has not set out a plan for what it wants to see afterwards. The government has not, has said it won't be publishing a plan because it wants to remain in. And so clearly that will also promote uncertainty in the short term. We're already seeing this show up in certain markets. I'm sure many of you followed and seen, particularly in sterling and the currency markets. The pound has weakened significantly against the dollar, but more generally against a broad set of currencies since the start of the year. And the question is whether this, whether a Brexit would trigger a further devaluation of the pound and a further weakening of sterling. The question now is how much has been priced in. I think there would likely be a further devaluation post-Brexit, but it's hard to be precise given this is an unprecedented event. But I think it's likely in that interim, the pound in particular, given what we've seen so far, would potentially exhibit a lot of volatility. In terms of other market indicators, there's actually been a bit less being shown. Equities, the FTSE 100, broader measures as well have been performing relatively well compared to other European indices. So it's not yet showing up significantly in that area and other parts of financial markets. Whether that means they don't think a vote will have a big impact or whether they don't think it will happen is not clear. I tend to lean towards the latter, in line with some of the betting probabilities that many people in financial markets are betting that we will remain, but we can't really see what the underlying motivations are. I think the big question for financial services is that this is a very fluid industry. In this transitional period of uncertainty, will they try to preempt and make moves, move certain businesses from London to the EU, for example? Would they try to move elsewhere to remove themselves from the volatility of this issue? So that is a potential problem, and again, I'll discuss this in more detail, but I think in the short term, there's a lot of unknowns. So when it comes to the economic assessments of this, people tend to focus on the long term, and that's what we have done. That's what the Treasury did in its analysis reach this week, which I'm happy to answer questions about later on. I think in the short term it's very hard to know what will happen. But I think if you look in the longer term, you can get a bit of a better sense of what the issues in play at least are. So in terms of the long-term economic impacts of a Brexit, we produced a study last year which looked at the potential impact of the UK leaving the EU. And basically what we try to examine is what is the initial economic impact, the first order effects of the UK leaving the EU and going into a number of different scenarios. And what we wanted to try and do different to some of the other reports that had been undertaken at the time and since is that we looked at both the negative scenarios and the positive scenarios. We tried to look both at what happens when you leave and then what happens when you take a response to leaving and how you might offset or mitigate some of the negative economic costs of leaving. And so as you can see from the slide on the screen, we found that the impact of Brexit could be anywhere between negative 2.2% loss to GDP or a gain of 1.5% of GDP. And these are both in the long run up to 2030 once all of the effects are fully shaken out. But the more realistic range would be between 0.8% loss or a 0.6% gain. And in terms of what all of those scenarios involve, the worst case would be the UK leaves without any transitional arrangement or without any new deal with the EU and falls back to trading on WTO rules as many other countries do, but losing out on the single market and losing out on all the other benefits it currently has. And that would see an initial hit of negative 2.2%. The realistic range looks at where the UK strikes a free trade agreement with the rest of the EU and then is able to offset some of the impacts. And in the higher realistic range, we look at some of the ways the UK can offset it in terms of deregulation and opening up to trade. And then in the very positive case, we look at a more extreme sort of trading and deregulation approach. I'll talk a bit more now about exactly how we get to those costs. So as you can see here, the initial costs from leaving are quite significant in some cases. And the interesting thing we found is that actually a lot of the costs arise from UK leaving the customs union. So the EU is a customs union. It has an external tariff and any goods and services inside that tariff can be traded freely and aren't subject to customs checks when crossing borders and things like that. And what we found is that when that custom border is reimposed, actually it's one of the most significant costs because there is a cost at the border where people are checked and goods are checked. There's an administrative cost for business in terms of filling out all of these forms and also with complying with what's known of rules of origin in the EU, which basically makes sure that the UK isn't importing cheap goods from elsewhere and selling them into the EU based on a potential free trade deal we might have. So these sort of compliance costs at the border are actually one of the most significant costs from leaving, and I think that's been reflected in some of the other assessments, and notably it's something the Treasury considers would be quite significant, although their estimates are quite a bit higher than ours of the impact of the border cost, I believe. In terms of the potential offsetting gains, the first one to note would be the EU budget saving. The UK would no longer contribute to the EU budget. Generally, this is worth around 0.5% of GDP. Now, we model a few different scenarios. In our FTA scenarios, as you can see under FTA 1 and 2, what we say is that, well, as has been shown by Norway and Switzerland, to get access to the single market, to strike a free trade deal, sometimes you have to promise to make some level of budget contribution. So we look at actually in those scenarios, the UK would continue to provide some budget contribution, and so would only save 0.2 rather than 0.5% of GDP, and therefore, is paying a bit of a price to remain part of or get access to the single market. Another potential offsetting cost is opening up to trade with the rest of the world. We take quite an extreme example here, just that the UK unilaterally opens up to the rest of the world in terms of free trade, so decides not to impose any tariffs or any costs on anyone else. Again, this is an extreme scenario, but gives a sense of what the gains from this type of trade are. And we look at, and found them to be around 0.75% of GDP in the longer run. So this shows that there are gains out there for this kind of trade. Obviously, if you did this rather than opening up unilaterally and did this in a series of negotiations and negotiating free trade agreements with many other countries, the gains would be higher because you are both opening up their markets and your own. But that would obviously take much longer and be a much more arduous process. And then the final area of potential gains is deregulation. So many people complain about the cost of regulation from Brussels and from the EU, and clearly I think there would be a scope for the UK to change policy outside, and we found that certain levels of deregulation, first in a more sort of politically feasible scenario, would deliver somewhere between 0.7% gain of GDP or 1.3%, which is quite an extreme scenario, and I've heard been described as Thatcherism on steroids, so it maybe wouldn't be as politically palatable, but it highlights that the potential gains are there if there is a political willingness. And so I think what we found is that there are potential steps to offset the initial impact of leaving the EU. It's hard to dispute that the initial impact of leaving the EU will be negative, particularly because you're leaving the customs union and there would be a border cost. So no matter what you negotiate, even if you negotiate a very comprehensive free trade deal, you will still have that border cost there, and that will mean a negative cost after leaving the EU. So the real question, I think, for the leave sides would be how do they move to offset this? And so we looked at how this is done. It's not something they've gone into detail on, although Michael Gove in his speech earlier today began to lay out this vision of a more free trading nation outside to try and boost GDP post-Brexit. But ultimately it remains pretty vague in terms of what they would want to see. Of course, I've made this sound very easy and that this is all very simple, but these are the first round effects. The longer term effects might be larger, but I think once you get past these effects, modelling it is very uncertain. The Treasury has tried to do that and others, and therefore has found much higher effects, but I think those impacts are also less precise and subject to a lot more uncertainty. But I think in terms of the steps that can be taken to offset any negative impacts, we shouldn't be benign about the impacts of those and what they mean. So I want to talk a bit more about those. Firstly, we found that sort of beyond the border, this is the issue I mentioned about opening up to free trade. Clearly there are potential gains out there. There are plenty of countries the EU doesn't have free trade agreements with. It currently has 32 agreements covering 62 countries, but it doesn't cover the USA. Negotiations are still ongoing, as I'm sure many of you are aware, and are taking a long time. It doesn't cover China. It doesn't cover India. So there are plenty of countries out there which we could strike free trade agreements with, or who we could enhance our trade links with post-Brexit. But I think we have to be aware that this is not necessarily as easy as it sounds. Not only does it take, as I said, quite a long time to negotiate free trade agreements, anywhere between 4 and 10 years. They're not always as comprehensive as we would like. They often don't go into the area of services. But more importantly, I think the recent political challenges we've seen in terms of the steel crisis in the UK, striking these free trade agreements would mean striking agreements with many emerging markets. Those are where the economic gains are for the most part. And clearly that would also mean opening up to low-cost competition from the rest of the world. There are many people on the Leave side who are free traders and who would embrace such a challenge. But I'm sure there are many people in the UK who are less confident or keen on that kind of approach. And I think the response to this challenge of Chinese steel undercutting UK steel has highlighted this political problem. So I think opening up and being a free trading and liberal nation post-Brexit would help, but it's not clear there's a political willingness to do that. Similarly, I think when you look at the on-the-border issues, these are the issues of migration. What we found in our assessments, both last year and our more recent one this year, is that to be economically prosperous outside, you probably need to keep pretty high levels of migration. Firstly, because if you are opening up to free trade and low-cost competition, you don't at the same time want to risk depriving your economy of much-needed labour supply and much-needed skilled migration. That would raise labour costs and make you even potentially less competitive against these other countries. I also think there are plenty of long-term fiscal reasons to keep migration high. And clearly we have also seen that business is suffering from certain skill shortages already, and therefore is keen to keep a relatively high level of migration. And if you look at what other countries do, if you look at the likes of Canada, Norway, Australia, Switzerland, these are the sorts of countries that are outside the EU, are medium or small or medium-sized countries globally, but they all have higher levels of migration than the UK over the past 15 years. So while they have more control over their migration systems, debatably, they still take high levels of migration. So I think what we found is that actually outside the EU, if you wanted to avoid a significant economic hit, you probably need to keep relatively high levels of migration. You could change the mix, move to a more points-based system, have more higher skilled labour from non-EU countries, but even there would probably still be a demand for low-skilled labour, which might require temporary visas and some kind of system to allow that to flow into the UK. So there are a number of challenges, and again, this raises the question, is this what people who want to leave the EU would like to see? And is this the type of system which they would go for? That is yet to be answered, but I think putting these choices out there is important to understand. And finally, in terms of the deregulation, the behind-the-border issue, as I mentioned, I think there is a question. There is regulation there which can be removed, but I think there is sometimes less than many people assume. While Brussels does impose lots of unnecessary bits of regulation, the real gains come from areas where you have a substantial policy difference from the EU. And these are areas such as social employment law, energy and climate change law, and even financial services. And I'll talk a bit more about the latter one later on. But I think for the first two, what we can see is that deregulating certain parts of social employment law, workers' protections, and also marking a significant change from our current climate change approach, which in many cases goes further than the EU, would be politically difficult and mean a change in domestic policy. So with all of these issues, with all the potential gains outside, there is a question of whether there is a willingness and ability for the UK to do that. And I think these trade-offs are what really need to be faced up to in the debate. Obviously, the big question as well is what sort of relationship would we have with the rest of the EU if we were outside? And we did an assessment of all the different potential models that are on offer at the moment, and we assessed them, as you can see in this table here, on a few metrics. The first being, what level of market access do you gain in the EU? What sort of say over the rules do you have? How much independence do you gain? And how negotiable is this model? And the ones that are often mentioned, the main precedents are Norway and Switzerland, Norway being in the European Economic Area, Switzerland having a more bilateral type of deal. And clearly, I don't think either of those options would suit the UK very well for a number of reasons. As you can see from the EEA model, it does give you significant market access. You are part of the single market still. However, you don't get any say over the rules. Norway doesn't have a seat on the European Council or in the Council of Ministers, which really have a huge influence over EU regulation. It does have some input in the sort of lower official level, but even then that's quite limited. Similarly, in terms of your gains from independence, we found that of the top 100 costliest regulations which the UK faces from the EU, Norway still implements 93 of those, so you don't get much scope to undertake this kind of deregulation that you might want to, and you still face probably a big level of oversight in terms of regulation from Brussels. And of course, you still have to accept free movement, and Norway has, as I said, higher levels of EU migrants per capita than the UK does. And finally, in terms of negotiability, I think it would be negotiable, but we shouldn't be prejudging this, because you also have to negotiate with the members of the EEA, because it would mean changing the voting arrangements and having a new member there, as well as the members of the EU. So in that sense, I think it's clear that the Norway model, for me and I think for many people, is probably not the right one for the UK outside. Similarly, the Swiss model, it is a complex arrangement, 20 bilateral agreements, 100 supplementary agreements. It's very hard to manage, and every issue and regulation an interaction between the EU and Switzerland has to be painstakingly negotiated, because it's not a rolling agreement, it's not a living agreement, and it has to be constantly updated. And so I think, again, in terms of the say over the rules, it's quite limited, and if you speak to Swiss officials and businesses, they tend to say, for ease of this interaction, they tend to accept plenty of the EU rules in any case, and don't try and fight it. If they did try and fight it, they may lose access to certain parts of the EU market until they implement the rules to do so. In terms of financial services, and services in particular, Switzerland actually has fairly limited access to the EU market. It's not part of the single market in services or financial services, and that's clear because Swiss banks and Swiss firms often have subsidiaries in London and other EU states. And if it wants to get access, it has to, again, implement all of the regulation. So I think it's, again, neither of the obvious options in terms of what relationship the UK would have with the EU post-Brexit, how it would continue to manage its trade, and how it would offset some of the negative effects from barriers going in and avoid going into a world where tariffs are imposed. None of the obvious options seem to suit the UK very well. And I think that, at the moment we're hearing more and more of this talk of a comprehensive free trade agreement similar to Canada or similar to what the US and EU are negotiating currently. We also looked at that briefly. As you can see, it is a mixture in terms of gains and access. I think this would be the most likely option the UK would go for if it were to leave the EU, given that it allows you to gain control over certain regulation, over immigration, and over certain other issues, but you could potentially negotiate some level of access. I think the precedent clearly set is that getting access in terms of goods is relatively straightforward. There are many free trade agreements that involve the EU opening up to the single market in goods. However, there are much fewer in terms of services, and this is a much more complicated issue. And this is where I want to delve into a bit more detail about financial services particularly, which is, I guess, what you're all here to hear about. And clearly it depends very heavily, as I said, on what the relationship is, and there is no real clear precedent for anyone having full access on financial services or services more generally to the EU markets, unless you are part of the single market. And that would mean being part of the European Economic Area, accepting all the regulations without having a say over it, which for a financial services centre the size of the UK, I think would be very unlikely to be desirable or to be the right approach to take. So clearly any other model would have to be an unprecedented negotiation. I think that one point to make is, clearly the UK is much more similar than anyone else to the EU. We are currently part of the same system. So on day one, we would still be, exactly the same as the rest of the EU, and therefore negotiating access should be relatively a bit easier. And this would happen through what's known as the equivalence process. So in order to get access in terms of financial services, and particularly the financial services passport, which allows banks and other financial firms who are registered and established in one EU country or one country outside to passport into all the other EU countries. And therefore that saves them having to go and set up branches and subsidiaries in these countries. So that is the process that we would have to go through. And to gain that passport, to be judged equivalent, essentially the EU has to decide that your regulations, your supervisory system is equivalent to theirs. It doesn't have to be exactly the same, but this is not a simple process, clearly, and in some areas, huge pieces of financial regulation, incredibly complex. It can take years to judge whether they are equivalent or not. It's also not just a box-ticking process. It's not a case of, okay, you've implemented broadly the same, we're fine, you have to implement these specific rules here and there. It's a very political process, and clearly once we leave the EU, there will be a question on the other side whether they would like to give us access, they would like to see the UK continue as an offshore financial centre for the EU and for the Eurozone. And so that allows this process also to be held hostage by political motivations. I would also note here one in particular question, as some of you may have followed in recent years. There was a dispute between the UK and the EU, particularly the ECB, over whether London could and should continue to be the offshore centre for trading in euros, and in particular whether central counterparties and clearing houses should be able to able to clear trades in euros, given that they are not part of the liquidity system in the Eurozone, and therefore there was a concern that they would not be able to adequately stand behind these transactions. Now, eventually the UK won that case and was able to continue to be the offshore centre and maintain its dominance in the trading of euros and euro instruments, thanks to the fact that it is part of the single market. Now, if we were outside, there is an open question whether that would be able to continue. And I think given the incentives in some other countries, they may well try and move some of the clearing and trading of euros back inside the Eurozone. So these are potential impacts and disruptions for the financial services sector. I think clearly it is a nexus of challenges. There's a huge amount of exposure. The passport works relatively well, but there's no precedent on how this would work outside. It's a very politically fraught issue, and the UK tends to be on a different page to many of the other EU countries in this issue anyway, and therefore how it would be negotiated outside is an open question. I think there are a few caveats to this, though. We don't want to go overboard, so I do want to present some of the other side of this. I think while I said the passport works well, I think specifically it works very well for the banking industry, particularly wholesale banking and wholesale finance. I think if you look at financial services more generally, it is a bit of a different story. In my experience, if you speak to particularly asset managers and particularly smaller and medium-sized asset managers, they don't feel they get the full benefit of a passport into other parts. They tend to be more domestically focused, and they believe that actually there are lots of other non-tariff barriers and technical barriers which raise the cost to doing business in other countries, even if they're allowed to passport their services in there as part of EU membership. And also, if you look at the insurance sector, it's far more diversified. It has much lower levels of trade with Europe and much higher level trade with the rest of the world, which suggests that they would maybe be a bit less exposed to these kinds of disruptions. So the impact across the City of London and financial services more generally is not uniform, and it won't be the same for everyone. So that is worth noting. But I do think, as I said, there is a particularly the wholesale banking, wholesale finance sector may be hit, and I think we have already seen some warnings from HSBC, I believe, and other firms saying they will look to move some of their trading, some of their capital markets teams over from London to Paris or other places in order to offset this risk. But there are a couple of other caveats as well. I mean, while plenty of other cities in the EU would like to claim to challenge London as a financial centre, it's not easily done. In the recent rankings of global financial centres, London came top, whereas a number of other countries were much further down. And so competing is not something that will come overnight or come easily, and also tapping into a large labour supply that is skilled enough to feed the needs of a big financial centre is not something that can happen overnight. But over time, I think there is a risk that people see for the financial services centre in that other sectors, and not just other centres in the EU, but other centres globally, would look to try and move business away from London. And the final thing, though, I would caveat as well, is that this is not just a problem for the UK. Currently, London is a global financial centre. If the EU did try and move some other business to Frankfurt, Paris, they are regional financial centres at best. And so it would reduce the size of the market, particularly the capital markets and the liquidity which firms and governments are able to tap into. And in the longer run, this could hamper the ease of financing for these organisations and for countries, and possibly raise the cost of finance. So there are potential costs for the other side as well in this disruption. And one final point I would make in terms of this, and also more broadly, is that with the UK outside, you'll be negotiating with a very different EU. I mean, the power balance has changed. The UK is the most open and liberal country, the most ardent protector of the financial services industry in particular. And as you can see from this, it's a crude graph, but it shows that with the UK in there, the more protectionist blocs and the more free trading bloc in the EU have an equal number of votes, and they're both able to block any regulation or any vote under qualified majority voting if they want to. But without the UK in there, protectionist bloc has a much larger sway, so it would be able to block more free trading regulations or more open regulations, and it might be able to push through more protectionist ones because the free trading bloc could no longer block it automatically. So this also brings into account that the bloc you're negotiating with might be a bit different to what it looks like now with the UK inside. So that sort of is the overview of how I see things happening. I don't think Brexit is the end of the world, and there are steps that can be taken to offset the costs. It's a question of whether there is a political willingness to do this, and as we've seen, some of those steps in terms of trade, immigration, regulation may not be politically acceptable or may not have huge amounts of political support. I do think the financial services sector is a potential nexus of issues, simply because we haven't heard what the Leave side would like life outside the EU to look, what relationship they would want with the EU, and what that would mean for the links between the EU and the UK in terms of financial services. So I'll leave it there, and now we can take some questions.
Yeah. Thank you very much, Raoul. You've made a lot of very complex issues a lot clearer, certainly for me and a lot of people on the call. And just before we address the questions, for our listeners, you'll find a copy of the slide pack on the attachments tab, along with the links to many of the Open Europe reports. And you can also keep up to date with regular tweets from Raoul and from Open Europe. So one of the questions that we did have is, what are the consequences of Brexit to the property market? Do you envisage we will see less foreign investment into the commercial property market and therefore potential for values to fall significantly?
Right. Well, very good question and very important question. I think, again, this comes down to a difference between the short-term and long-term effects. I think, as I said, in the short-term uncertainty, many people do expect foreign direct investment to be disrupted and to fall. And I think commercial property is potentially one of those that could be hit. Again, we don't have any precedent to compare this to. If you look at the Scottish referendum, we know that there was a huge slowdown in commercial property around that period. I say that was a bit more complex because of the currency issues and the debt issues, but even here there is a risk that we see a similar slowdown and a similar impact if we did leave the EU. In the longer run, though, there's a question of whether, even if FDI from the EU slows down, whether it is increased from other parts of the world, whether domestic, investment increases. It's not obvious to me from the literature and the empirical evidence whether foreign direct investment actually crowds in other investments, so brings other investors along, or whether it crowds out some investment, and therefore if we lose some FDI, other investment may take its place. I don't think it's conclusive on which way that would go, although I know that doesn't really give you much help. I think there are another couple of issues to consider here as well. Obviously, in the short-term uncertainty, the reaction of banks in terms of lending and their risk-taking will probably be to sort of pull back. I would think they would become more risk-averse, and that might reduce the access to finance. There's also a big question over what the Bank of England does in response to this. As I said, I think there will be a negative economic shock, so you would expect the Bank of England to ease more or keep rates lower for longer, maybe provide more liquidity to the market. But at the same time, we also have quite a sharp potential devaluation in the pound, and therefore easing into that could potentially worsen a devaluation. So it's a tough position for the Bank of England to be in, so it's not clear again what that response would be. So all of those factors together present quite a complex picture for the property market. I think that there is a potential decline in investment, particularly around the vote and during the short-term period of uncertainty. I think in the longer term, the prospects for the broader market remain quite good. But a lot of this, again, will depend on how quickly we manage to move and figure out what sort of relationship we're going to have with the EU and with the rest of the world.
And you touched on this just there about the property prices within the Scottish referendum, so that leads quite nicely into our next question. What would the impact be on Scottish independence movement in the event of Brexit?
Another question.
Yeah.
I think that, well, I mean, I think it's an open question. My sense is that there would clearly be a huge amount of pressure to have another vote on Scottish independence.
Yes.
But I think that vote might be harder to win this time around for a number of reasons. I mean, firstly, Scotland would not only be leaving a currency and debt union in the form of the UK, but it would also be leaving a customs and trade union in form of the EU, so that's a sort of double whammy, and the economics of it would be incredibly painful. Obviously, oil is at very low prices, and that continues to hamper the sort of fiscal outlook for Scotland as an independent nation. But also, it's not clear whether Scotland would actually be able to stay in the EU or rejoin the EU very quickly. There are lots of politically fraught issues here around, particularly Catalonia in Spain. Spain would have to approve Scotland staying in the EU or rejoining the EU very quickly, and for Spain that would set a bad precedent, potentially encouraging Catalonia to go for independence as well. So, because of these issues, I think there may well be a second referendum if we did vote to leave. I think it would be harder to win, but equally, it's not clear that if you just have a referendum to leave the EU, whether you then want to risk going through another referendum on Scotland. So I do think this is an issue which is weighing on people and which may convince some swing voters that they don't want to risk taking the uncertainty of both leaving the EU and potentially splitting up the UK Union.
Yeah. What sort of other doors would be opened in this event? Yeah. We have another good question come in. Do you think the merger between the London Stock Exchange and Deutsche Börse will still hold if the UK leaves the EU?
Yeah, another good question. Well, this actually ties into a point I was making about the clearing of euros, and it's an interesting question. I mean, obviously, I think they've made it clear that Brexit is not a big issue for them. And I think one way you can look at it is actually it might preempt some of the challenges of Brexit, because if you have the London Stock Exchange, which will become basically majority owned by Deutsche Börse being the larger part of the merger, then while the London Stock Exchange is based in London, it is part of a European conglomerate, and its main base would be in Frankfurt. So that might simplify the problem in terms of getting access to clearing euros, since it would technically be a Eurozone-based company. So that might actually preempt some of the Brexit challenges. It might also be a case that some of the clearing and euro trading, if they do merge, is going to move to Frankfurt anyway, and you might see a different divide in how business is done. They might stop a duplication of some trading, move some to London, move some to Frankfurt, and they might become different sort of hubs for different types of trading. I mean, in terms of trading euros or trading other broader global currencies. So my sense is that they know what they're getting into. I think they've made it clear they're not overly concerned about Brexit. And actually, if it's managed in the right way, it may actually avoid some of the potential challenges of Brexit. So it's an interesting issue to look at in that sense.
Yeah. And I think your answer has possibly covered the next question as well, but I'll field it anyway. Could Brexit trigger the collapse of the EU, and what would be the impact of the FTSE or other European world markets in the event of a Brexit? Could this lead to another recession?
Right. Well, the triggering the breakup of the EU is a good question. I mean, I think there is genuine concern about this in the rest of Europe. We held a sort of simulated event earlier this year looking at the simulating potential post-Brexit negotiations with a number of high-level EU politicians, including former Deputy Finance Minister of Germany, former Europe ministers, former foreign ministers from a number of countries. And one of the main things they said is they really genuinely believe that a Brexit would be a huge destabilising force on the EU and could promote other countries to want to follow suit. I think this is maybe overblown a bit. Not many other countries are in the same position as the UK in terms of wanting to leave, in terms of the long-term scepticism of the EU. Also the fact that many countries inside the Eurozone, even though the Netherlands is quite sceptical, Finland, even Italy is growing in terms of scepticism. Leaving the Eurozone and leaving a single currency is a much bigger question in terms compared to leaving the EU from outside the Eurozone. So I think for that reason, I don't think it would immediately trigger an unravelling of the EU, but it is a huge political blow to the project, and I think that it would really cause them to have to reassess. If you look at the crises the EU has faced in terms of the Eurozone crisis, the refugee crisis, and if it then had another political crisis from Brexit on top of that, it's failed to truly respond to the first two. If it didn't respond to the third or to all of them in a sense, then I think people would start raising questions about where Europe is going as a project.
Right.
And in the longer term, that would certainly hurt it. So, while it doesn't, start the unravelling, in my view, it does pose big questions. And if they don't respond adequately, then in the longer term, people will more openly and more clearly start questioning why they are part of this club.
Right.
In terms of the FTSE and other indices, well, a lot of this will depend on, as I said, on the longer run negotiations. In the short run, there's going to be a lot of volatility, and I think the FTSE will take a hit. There are certain companies which will be more exposed than others. I think clearly financials are quite exposed, and I think if there is a big drop in economic confidence, then that will feed through more broadly. So there is a potential for a downturn in that sense. In terms of other indices, there might be a drop-off for specific companies that are exposed in terms of trade, but we have to bear in mind that you do have this 2-year transition period, so nothing will change at least for 2 years. So while there might be an initial drop, I don't think investors will necessarily be positioning on day 1 or 2. They might give it a bit of time to see how the negotiations begin shaping up. I also, I don't buy the IMF view that this is a global shock. Most of the models I've done and the models I've seen and the economic forecasts I've seen don't show this being a huge economic shock globally. So I find it hard to believe that it would really have reverberating impacts much beyond the UK and Europe in economic terms. But that's my sense of it.
So not going to be plunged into a world recession as a result?
I think not.
No. And the final question leads back to your very early slides, which you mentioned it's asking about the disparity between the poll results online versus the telephone results. And they've asked, what's your view on the cause? And you touched on some of the questions or answers or how people felt when they were actually being interviewed.
Yeah, sure. Well, I'll just go back to the slide so you can see a bit more on where the differences come from. Sorry. Yeah. So, well, I think the differences, as I said, generally seem to come from, and this is based on one of the polling firms that did a lengthy assessment of the differences. They come from firstly the don't know effect, which is basically people on the phone don't often get an option. When you get a call from a pollster that says, do you want to remain or do you want to leave? They don't then ask you don't know. So people don't always account for that and just say, oh, remain or leave. And therefore there seems to be much lower don't knows in phone polls. While in online polls they're sort of 17 to 20%, in phone polls much lower, sort of 9 or 10%. So I think that accounts for quite a bit of the difference. As I said, the phone polls tend to go through, obviously you don't have to sign up to them, so it's not self-selecting in that sense. They generally go through a large random sample of people, and they call many people, and so I think it captures a broader audience, and that accounts for potentially people being less politically interested, feeling less strongly about certain issues, particularly something such as the EU. But also they tend to be, according to this analysis at least, a bit more liberal, a bit more, open-minded in that sense, and therefore they tend to lean a bit more towards Remain. So I think there is a sense that those are the main reasons, but even within that we don't quite know. I think obviously there's also worth noting there's a big difference between different generations, different regions,
Yes.
and different sort of wealth levels. So much older voters are much more sceptical and much more likely to go out and vote, and much more likely to vote to leave. I think in terms of the regions, London and the South East, along with Scotland and Northern Ireland, I believe, tend to poll much more in favour of Remain, whereas I think the Midlands and the North East tend to poll more sceptically. And then in terms of the different levels of wealth, the wealthier and better educated, who are also actually more likely to go out and vote, which may offset some of the older votes, they tend to favour Remain, whereas the less wealthy tend to favour leaving, but also are less likely to vote. So there's a huge number of moving parts,
Yes.
and that's why it's so hard to estimate.
Yeah.
But I think it all tells me, what the key takeaway from all of this for me is that turnout is a crucial issue on the day.
Right. Yeah.
If we get, we know the older voters who are very sceptical are going to turn out. We know this will be offset partially by the better educated, well-off people who will also turn out. But if younger voters who tend to much more heavily favour Remain not turn out, then it favours Leave. And I think generally the lower the turnout, the more it favours the Leave side.
So yeah, the demographics are really interesting. So that the underlying message is use your vote now, and you've certainly gave us a lot clearer picture, Raoul, on the impacts both across the board and for financial services. So thank you very, very much for that. I'd ask one last favour for the audience, if they could give us a rating for the webcast and feedback so that we can keep delivering what you would like to hear. And I'd say that the webcast is available on the same link as the invitation. And I want to thank Raoul again, who's going to be flying off to Copenhagen, I believe, soon. And I'd like to thank everybody at home for joining us. And have a great day. Thank you. Bye now.
Thank you.